The night the market moved, most people were sleeping. Somewhere in a dark room, a trader woke up to the blue light of a smartphone only to see his entire life savings erased in a matter of minutes. Somewhere else, a young investor closed her laptop with trembling hands and whispered that this is the moment she either quits forever or she levels up to a new version of herself. And in another corner of the globe, a quiet winner looked at the exact same red candles on the screen and smiled. This smile was not born of cruelty or ease, but of a deep understanding that this is exactly how wealth is transferred in the modern world. When silver collapsed from $88 to $74 after 41,000 traders were liquidated overnight, it was not just a statistical market event. It was a brutal life lesson delivered in real time. It was the market reminding every participant that emotion is the most expensive luxury you can afford, while discipline remains priceless and patience is a genuine superpower. I remember sitting in my car years ago completely broke and listening to a podcast about a man who lost everything during the dot-com crash of 2000. He rebuilt a fortune larger than his original one by learning a single fundamental rule: never confuse volatility with failure. That one idea changed how I viewed money risk in the very fabric of life. The market is not just a place where assets are traded. It is a mirror. It reflects exactly who you are when things stop going your way. Here is the first truth most people never learn. Every major fortune in human history is built during times of absolute chaos. The masses see disaster, but the elite see a massive discount. While the gambler loses everything, the builder is busy sharpening his strategy. We are living in an era where the ground beneath our feet feels unstable. Headlines are heavy with the weight of inflation, debt, and geopolitical shifts. Most people are waiting for the storm to pass so they can feel safe again. But you must understand that the storm is not the enemy of your success. It is the environment where true success is forged. It is the high-pressure chamber that compresses ordinary thinking into extraordinary results. If you own 500 ounces of silver or any significant asset, you are currently a target of the volatility. But whether that volatility destroys you or elevates you depends entirely on your internal architecture. In this video, we are going to deconstruct the mechanics of wealth transfer and the psychological warfare of the financial markets. We will look at why 41,000 people lost everything in a heartbeat and how you can position yourself to be on the receiving end of the greatest wealth transfer in history. This is not about luck. This is about the cold, hard logic of survival and the courage to remain standing when the world decides to shake. To understand why 41,000 traders were wiped out in a single night, we must look past the price of silver and into the mechanics of human greed and the structural traps of the financial system. A liquidation massacre occurs when the market moves against a leveraged position so violently that the exchange or the broker is forced to close the trade to protect itself. This creates a domino effect. As one position is forcibly closed, it puts more downward pressure on the price, which triggers more liquidations, and the cycle continues until the market is purged of those who took too much risk. The primary culprit in this disaster was not the silver market itself, but the misuse of leverage. Leverage is a tool that allows a trader to control a large amount of silver with a very small amount of actual capital. Imagine a trader using 20 times leverage. A mere 5% move in the price against him would result in a 100% loss of his initial investment. On that specific night, the price movement was sharp and unforgiving. Those 41,000 individuals were not necessarily wrong about the long-term value of silver, but they were catastrophically wrong about their ability to survive the journey. They were overexposed and underprepared. This event is a perfect case study in the psychology of the margin call. When a trader receives a margin call, it is the sound of a death knell for their account. Most people react to this with a mixture of denial and hope. They add more money to a losing position, or they pray for a sudden reversal that never comes. But the market has no ears for prayers. It only respects the cold reality of math. The 41,000 traders failed because they built their houses on the sand of borrowed confidence. They focused only on the potential reward and completely ignored the absolute certainty of risk. History has shown us this pattern repeatedly. In the year 1998, a hedge fund called Long-Term Capital Management, which was run by Nobel Prize winners and the most brilliant minds on Wall Street, collapsed because of the same underlying issue. They had used extreme leverage based on complex mathematical models that suggested the market would remain rational. But markets are not rational because humans are not rational. When the Russian financial crisis hit, the volatility exploded and their models failed. They were liquidated because they did not account for the outlier events. They did not leave enough dry powder to survive the storm. In the world of silver and precious metals, this lesson is even more vital because of the inherent volatility of the asset class. Silver is often called the devil's metal because of its tendency to move in violent swings. If you are a long-term builder, you view a 15% drop as an opportunity to accumulate more at a better price. But if you are a leveraged gambler, that same 15% drop is the end of your financial journey. The massacre of those 41,000 traders serves as a stark warning to anyone watching this. You must never let your ego dictate your position size. You must respect the power of the market to remain irrational longer than you can remain solvent. Wealth is not just about what you can gain. It is about what you can keep when the world turns red. To understand the current volatility in silver, we must look back at the grand tapestry of economic history. Wealth is never truly destroyed. It is simply moved from one hand to another. This movement usually occurs during periods of extreme fear when the majority of the population is blinded by panic. The most famous example in modern history began in October of 1929. As the stock market crashed and the Great Depression took hold, most people saw the end of the world. But for those with a long-term perspective and available capital, it was the beginning of an empire. Joseph Kennedy Sr., the father of a future president, famously exited the market before the crash and then used his liquid wealth to buy up real estate and businesses for pennies on the dollar. He understood that while the crowd was selling in terror, the underlying value of assets remained. Moving forward to the 1970s, we see another massive transfer during the era of stagflation. As inflation climbed into double digits and the dollar lost its purchasing power, those who held traditional savings accounts saw their wealth evaporate. However, those who recognized the shift into hard assets like gold and silver saw their net worth explode. In 1971, the price of gold was $35 per ounce. By 1980, it had reached $850. This was not just a price increase, it was a massive transfer of purchasing power from those holding paper currency to those holding tangible value. If you were positioned correctly, you were rewarded for your foresight while the rest of the world struggled to pay for basic necessities. The year 2008 provided yet another brutal lesson in this cycle. The subprime mortgage crisis triggered a global financial collapse that wiped out trillions of dollars in household wealth. Millions of people lost their homes and their retirement accounts. Yet during this period of absolute darkness, the prepared moves were being made. Warren Buffett, the legendary investor from Omaha, deployed billions of dollars into companies like Goldman Sachs and General Electric when no one else would touch them. He famously told investors to be greedy when others are fearful. While the average person was focused on survival, the visionary investors were already building the future. They acquired high-quality assets at prices that would never be seen again once the dust settled. The common thread in all these historical events is that the transfer of wealth is always facilitated by a lack of preparation and an abundance of emotion. In 1929, it was the lack of liquidity. In the 1970s, it was the lack of protection against inflation. In 2008, it was the overextension of debt. Today, as we see 41,000 traders liquidated in the silver market, we are seeing the same mechanism at work. The market is shaking out the weak hands and the over-leveraged participants to prepare for the next leg up. History proves that the most powerful companies and the most significant family fortunes are often born in the middle of a recession or a market crash. These entities do not emerge because their founders were lucky, but because they stayed calm while the world lost its mind. They stayed liquid while others were locked in bad bets. They stayed focused on the data while others were distracted by the noise. If you want to be on the right side of history, you must study these cycles. You must realize that a crash is not a signal to run away. It is an invitation to step forward. When you look at the silver charts today, do not see a disaster. See the footsteps of history repeating itself and ask yourself if you are positioned to catch what is about to fall. Leverage is one of the most misunderstood forces in both the world of money and the journey of life. Most people view it simply as a financial tool, a way to multiply profits or buy things they cannot yet afford. But the deeper truth is that leverage is a mirror. It does not create your character, it reveals it. It takes whatever discipline, patience, fear, or ego already exists inside you and turns the volume up to a level that can no longer be ignored. When you enter the silver market with high leverage, you are essentially inviting an accelerant into your house. If your foundation is strong, the fire will warm you, but if your foundation is weak, it will burn everything to the ground in a matter of hours. In the world of finance, leverage is often the primary reason why brilliant people go broke. Think about the 41,000 traders who were liquidated. Many of them likely had excellent research and a correct long-term thesis on silver. However, they allowed their ego to dictate their position size. They wanted to get rich today instead of becoming wealthy over a decade. This impatience is a character flaw that leverage exposes instantly. When the market moves against a leveraged position, it creates a psychological pressure that most humans are not biologically wired to handle. Your heart rate increases, your logic shuts down, and you begin to make decisions based on the survival instinct of the primitive brain rather than the strategic planning of the modern mind. This principle extends far beyond the trading screen. Growth itself is a form of leverage. When a small business suddenly scales to 10 times its original size, every hidden weakness in the leadership and the culture becomes a gaping hole. If the founder is disorganized, that disorganization will now cost 10 times as much. If the communication is poor, the misunderstandings will now affect 10 times as many people. Many businesses fail not because they lacked opportunity, but because they grew before their systems and their discipline were ready to handle the weight. Leverage did not ruin them, it simply pulled the mask off their existing instabilities. In your personal life, leverage appears in the form of increased responsibility, influence, or sudden access to capital. We have all seen stories of lottery winners who go bankrupt within a few years, or young celebrities who spiral out of control. The sudden influx of leverage did not change who they were, it simply gave them the resources to be more of who they already were at a faster pace. If a person has not mastered self-control with $1,000, they will certainly not master it with $1 million. The external expansion must be preceded by internal fortification. To survive the traps of the modern economy, you must become the kind of person who can handle leverage without losing your soul or your shirt. This means strengthening your discipline before you increase your risk. It means refining your habits while you are still playing for small stakes. It means mastering the art of the wait. Those who build lasting success understand that the real work happens in the silent seasons before the rewards arrive. They know that when the leverage enters the picture, there is no place to hide. You must decide today, while the market is relatively calm, whether you are a gambler chasing a high or a builder constructing a fortress. Because when the next wave of volatility hits, the mirror of leverage will show the world exactly who you are. The most dangerous myth in the world of finance is the belief that you must be able to predict the future to become wealthy. Millions of people spend their lives chasing the perfect forecast, looking for the one guru or the one algorithm that can tell them exactly what will happen tomorrow. But the giants of industry and the legends of investing like Ray Dalio and Warren Buffett operate on a completely different frequency. They understand that the future is inherently unpredictable. Instead of trying to guess where the wind will blow, they focus entirely on positioning their ship so that it thrives regardless of the direction of the storm. Positioning is about structure, while prediction is about luck. If you look at the portfolio of a master investor, you will see a fortress designed to withstand 1,000 different scenarios. When Ray Dalio discusses his all-weather strategy, he is not making a bet on silver or gold or stocks in isolation. He is positioning his capital across different asset classes that perform well in different economic environments like inflation, deflation, or high growth. By doing this, he removes the need to be right about the next headline. He has already won because his position is sturdier than the market's volatility. In the case of the 41,000 traders who were liquidated, their failure was a failure of positioning. They made a prediction that silver would go up, and they bet everything on that single outcome. When the reality shifted, even slightly, they had no defense. They were out of position. Contrast this with a strategic physical silver holder. If the price drops 20%, the physical holder is still in the game. Their position is one of ownership and low or zero leverage. They do not need the market to be right today because their time frame is measured in years, not minutes. They have positioned themselves to benefit from the long-term debasement of currency, and short-term fluctuations are merely noise. Positioning also applies to your personal resources. Cash is a position. In a world where everyone is fully invested in chasing the latest trend, having a significant pile of dry powder is a strategic advantage. It allows you to be the one who provides liquidity when everyone else is desperate for it. Knowledge is also a position. If you have spent years studying market cycles and the history of silver, you are positioned to stay calm when the news cycle screams for panic. You are not reacting to the price. You are reacting to the data you have already mastered. The strategy of giants is to focus on what they can control. You cannot control the Federal Reserve, you cannot control geopolitical conflict, and you cannot control the silver spot price. But you can control your debt levels, your savings rate, your emotional state, and your level of diversification. When you shift your focus from trying to be a prophet to being an architect, your anxiety disappears. You stop asking what will happen and start asking if you are ready for anything to happen. This is the hidden secret of the wealthy. They do not have a crystal ball. They simply have a better map and a much stronger ship. To truly master the silver market, you must understand that silver is not a typical asset. It is a hybrid between an industrial metal and a monetary store of value. This dual nature is the source of its legendary volatility. In the eyes of the average person, a 20% drop in silver prices looks like a failure of the investment. They see the red numbers and conclude that they were wrong. But the sophisticated investor looks at the same data and sees truth in motion. Volatility is not the same as failure. Volatility is simply the price of admission for the massive gains that hard assets provide over time. If we look at the historical data from the last 50 years, silver has experienced multiple drawdowns of over 50%. In the late 1970s, silver went on a spectacular run, but it did not go up in a straight line. There were weeks of brutal sell-offs that shook out the weak hands. The individuals who became wealthy during that decade were not the ones who traded the swings perfectly. They were the ones who understood the fundamental macro environment of high inflation and negative real interest rates. They held through the volatility because their thesis remained intact even when the price did not reflect it. The current silver market is no different. We are seeing a massive increase in industrial demand for silver in sectors like solar energy and electric vehicle manufacturing. Simultaneously, the global supply of silver has been in a deficit for several consecutive years. In 2024 alone, the silver market saw a deficit of over 200 million ounces. When you combine these supply and demand fundamentals with the ongoing debasement of the world's major currencies, the long-term case for silver becomes mathematically overwhelming. The liquidation of 41,000 traders does not change these facts. It actually strengthens the market by removing the speculative froth and transferring the metal from short-term gamblers to long-term holders. One of the most important metrics to track is the gold to silver ratio. Historically, this ratio has averaged around 15 to 1 or 16 to 1 for centuries. In the modern era, it has fluctuated wildly, but it often reverts to a mean of around 45 to 1 or 60 to 1. When the ratio spikes to 80 to 1, or 100 to 1, as it has in recent years, it signals that silver is historically undervalued compared to gold. During these times, the volatility usually increases as the market tries to find its footing. If you view this through the lens of failure, you will sell your position at the bottom. If you view it as a case study in market cycles, you will see it as one of the greatest buying opportunities of your lifetime. You must learn to embrace the volatility. In the world of high finance, the most successful players use volatility to their advantage. They use options to hedge, or they use price dips to accumulate more physical metal. They understand that without volatility, there would be no profit. If the price of silver moved up by exactly 5% every year, there would be no opportunity for a wealth transfer. The chaos is the very thing that creates the gap between the prepared and the unprepared. When the next market shakeout happens, do not look at the price chart with fear. Look at the industrial demand figures, look at the mining supply data, and look at the debt levels of central banks. The price is a lie told by the paper market, but the volatility is the truth that reveals who truly believes in their research. Emotional control is the quiet force behind every great fortune, yet it is rarely discussed because it is invisible to the outside world. Inside every successful investor, there is a private discipline that governs reactions long before the results appear. Most people are slaves to their neurobiology. When the market flashes red and the headlines scream disaster, the human brain releases cortisol and triggers the fight or flight response. This is why people sell at the bottom. They are not making a logical decision, they are trying to stop the pain of losing. To win in the world of silver and finance, you must practice emotional alchemy. You must learn to take the raw energy of fear and convert it into the cold fuel of logic. The charts do not destroy trading accounts, behavior does. Every market cycle repeats this lesson for those willing to observe it. When silver dropped and 41,000 traders were liquidated, the damage was not done by the price of silver itself. The damage was done by the panic that forced them to close their positions or the greed that made them over-leverage in the first place. You must realize that your emotions move faster than your logic, and they are much louder than your reason. If you do not have a pre-established system, your emotions will make the final decision every single time, and in the financial markets, acting on emotion is the fastest way to poverty. The secret to emotional alchemy is to replace hope with a system. Hope is not a strategy. Many of those who lost everything were hoping for a bounce or hoping the market would be fair. The disciplined builder does not hope. He has a set of rules that dictate his actions. If the price reaches level A, he buys. If the price reaches level B, he waits. If the volatility exceeds a certain percentage, he stays liquid. By following a predetermined script, you bypass the emotional centers of the brain. You stop asking how you feel about the market and start asking what your plan says to do. This shift from feeling to executing is the hallmark of a professional. In the world of business and leadership, this same stability is a competitive weapon. During a downturn, most leaders panic and cut the wrong costs or abandon their long-term vision. But a calm leader slows down the noise. He gathers the data, he communicates clearly to his team, and he looks for the strategic advantage that uncertainty provides. He knows that his clarity is more valuable than his capital. While the competition is paralyzed by fear, the disciplined leader is reorganizing and advancing. This is why the calmest person in the room usually ends up owning the room. They are the only ones capable of seeing the path forward when everyone else has their eyes closed in terror. To master your emotions, you must treat your mental training as seriously as your financial training. You must practice stillness when the world is chaotic. You must practice humility when you are winning and resilience when you are losing. Do not try to eliminate your emotions because they are a natural part of being human. Instead, you must master them. You must learn to observe your fear without letting it take the steering wheel. When you can look at a massive market crash and feel the same level of detachment as if you were watching the weather, you have achieved emotional alchemy. At that point, you are no longer a participant in the market, you are its master. To protect your wealth and profit from the next transfer, you must stop acting like a consumer and start thinking like a fortress builder. A fortress is not just a pile of silver or a bank account. It is a comprehensive system designed to withstand prolonged siege and exploitation. In the financial world, this fortress is constructed from three primary materials: cash, knowledge, and your network. If you lack any one of these pillars, the structure will eventually collapse when the pressure of the market becomes too great. The first pillar of your fortress is cash, or what professional investors call dry powder. Many people believe that every dollar must be invested at all times to maximize returns. This is a fatal mistake. Cash is not just currency, it is a strategic option. When 41,000 traders were being liquidated, they were desperate for cash to save their positions. Because they had no reserves, they were forced to sell at the bottom. The builder who keeps 20 or 30% of his wealth in liquid cash is the one who can buy those liquidated assets for a fraction of their value. Cash gives you the power to be patient. It allows you to wait for the perfect pitch instead of swinging at every ball the market throws at you. The second pillar is knowledge. In the modern economy, information is abundant, but wisdom is rare. Most people spend their time chasing the news of the day, which is designed to trigger an emotional response and sell advertising. To build a fortress, you must ignore the noise and study the signal. This means understanding the history of the Federal Reserve, the mechanics of the bond market, and the physical supply chains of commodities like silver. When you possess deep knowledge, you are no longer afraid of a market crash because you understand the underlying causes. You know that a price drop in silver is often a paper manipulation rather than a physical reality. Your knowledge becomes the shield that protects your mind from the psychological warfare of the media. The third pillar is your network. No one builds a significant fortune in total isolation. The quality of your information and the speed of your execution depend heavily on the people you surround yourself with. You need a network of mentors, peers, and experts who think strategically and act with integrity. During the 2008 financial crisis, while the public was panicking, the elite were sharing information and forming syndicates to buy distressed real estate and undervalued companies. If your network consists of people who only talk about sports or celebrity gossip, you are at a massive disadvantage. You must seek out individuals who have survived multiple market cycles and who can provide a perspective that you cannot see on your own. Building this fortress takes time, and it requires you to make sacrifices in the short term. It means choosing to save instead of spending on a new car. It means choosing to read a difficult book on economics instead of scrolling through social media. It means reaching out to people who are more successful than you and finding ways to be of value to them. But once the fortress is built, you move through the world with a different level of confidence. You no longer fear the storm because you know that your structure is real. You are no longer a target of the market, you are the one who stands ready to capitalize on the chaos that destroys everyone else. Most people wait for perfect conditions before they begin building their future. They wait for the economy to improve, for interest rates to drop, or for the political climate to become more predictable. But history reveals a profound truth that every successful man must internalize. Sunshine rarely creates anything meaningful. Comfort produces dreams, but storms produce builders. The architects of destiny do not wait for the rain to stop. They learn how to build in the rain. They understand that the moments when everything feels heavy and uncertain are the exact moments when the greatest growth is possible because the competition has gone home to hide. When the environment is calm, many people talk about what they will do someday. They plan and they imagine, but they rarely execute with intensity. However, when the storm arrives and resources become scarce, the distractions are stripped away. Hardship demands action and adversity eliminates excuses. This is why some of the most powerful companies in the world, like General Motors or International Business Machines, were forged during periods of extreme economic depression. The founders of these empires did not have it easy. They had to be more efficient, more creative, and more disciplined than anyone else just to survive. That pressure created a foundation so strong that it lasted for over 100 years. In your personal financial journey, you must embrace this same mindset. The days when your portfolio is down and the media is telling you that silver is a dead asset are the days when your character is actually being built. Anyone can be a genius in a bull market when every investment is going up. But it takes a true architect of destiny to stay focused when the world is in a drawdown. This is the time to refine your systems. This is the time to cut the fat from your budget and double down on your education. If you can maintain your discipline when your motivation has disappeared, you become dangerous to your competitors because you have developed a strength that they do not possess. The storm also serves as a filtration system. It removes the illusions and reveals what truly matters. It shows you which of your habits are strong and which ones are just for show. It shows you who your real friends are and which of your business partners can be trusted under pressure. Once you learn how to operate inside the chaos, you stop fearing the next crisis. You realize that every storm carries the raw materials for your next level of success. You begin to look at a market crash not as a threat to your current wealth, but as the construction site for your future empire. The transition from a victim of circumstance to an architect of destiny happens the moment you accept that you are responsible for your own outcome, regardless of the external weather. You stop complaining about the silver price or the government, and you start focusing on your own execution. You build your fortress, you sharpen your skills, and you stay ready. When the shaking finally stops and the sun comes out, the people who were hiding will look at you and call you lucky. But you will know the truth. You did not win because of luck. You won because you were the only one busy building while everyone else was waiting for the perfect day. We have journeyed through the wreckage of the silver market and the corridors of economic history to arrive at a single, unavoidable conclusion. The market does not decide your destiny, your mindset does. The liquidation of 41,000 traders was not a random tragedy, it was a structural necessity. It was the system purging those who brought greed to a place that requires discipline, and those who brought hope to a place that requires a plan. If you are still standing after the smoke clears, you have been given something more valuable than profit. You have been given an invitation to the next level of your financial and personal evolution. Wealth is not a destination, it is a process of becoming the kind of person who can attract and sustain it. You must remember that volatility is not chaos, it is truth in motion. It is the moment when the mask falls off the market and off the people inside it. When the world is stable, everyone looks like a winner. But when the world shakes, only those with a real foundation remain. If this message has sharpened your perspective and reminded you of what you are capable of, then you must not let this energy go to waste. You must take the logic we have discussed and turn it into immediate action within your own fortress. Do not be like the crowd that watches a video and then returns to the same habits of distraction and debt. Start by auditing your current position. Are you overleveraged in any area of your life? Do you have enough dry powder to capitalize on a sudden discount in silver or real estate? Is your knowledge deep enough to keep you calm when the next headline screams for blood? If the answer is no, then today is the day you begin the work. Build your system so that your emotions never get to make the final decision. Respect risk more than you crave reward, and always keep your time frame longer than the noise of the media. The great wealth transfer of our era is already underway. It is happening in the silver mines of Mexico, it is happening in the halls of central banks, and it is happening on the trading screens of every major city. This transfer is moving resources away from the reckless, the impatient, and the unprepared, and toward the disciplined, the strategic, and the courageous. You have the map, and you have the history. The only remaining variable is your own behavior. Will you be a target of the market, or will you be the architect of your own future? The crash is not the end, it is the beginning. It is the pressure chamber that will turn your efforts into an unbreakable legacy. Stay liquid, stay focused, and stay disciplined. The next level of your life is not waiting for a better economy, it is waiting for a better version of you. If you are ready to accept this invitation, then keep moving forward with the quiet confidence of a man who knows exactly where he is going. Like this video to seal these truths into your mind, and subscribe to join this fellowship of strategic builders. The world belongs to the calm and the prepared. Go out and claim your position.